At first, it looked like good news. The letter arrived on a quiet Tuesday morning. It wasn't from the bank. It wasn't another mortgage statement. It was an insurance renewal. The homeowner expected a small increase, maybe a few dollars a month. Instead, the annual premium had jumped by more than $2,000. Nothing about the house had changed. The mortgage payment was exactly the same. The family hadn't filed a major claim. Yet the cost of keeping that home had quietly become much more expensive. And that's the part of homeownership most people never calculate. When people shop for a home, almost every conversation revolves around one number: the purchase price. Can we afford the monthly mortgage? Can we qualify for the loan? Can we negotiate another $10,000 off the asking price? Those questions matter, but they hide a much bigger one. What will this house actually cost us over the next 10, 20, or 30 years? Because the day you receive the keys isn't the finish line. Financially, it's the starting line. Chapter 1. The number that sells the dream. Walk through almost any open house in America and you'll hear similar conversations. What's the monthly payment? What's the interest rate? Can we lock today's rate? Those questions make perfect sense. After all, for most families, buying a home is the biggest financial decision they'll ever make. But notice what almost nobody asks. How much will it cost to keep this home? That's a different question, and it's often the more important one. According to the Federal Reserve, real estate represents the largest source of wealth for many American households. Owning a home has helped millions of families build long-term financial security. But building wealth and managing cash flow are not the same thing. A family can own a valuable house and still struggle to pay monthly bills. That's because equity doesn't pay for a new roof. Equity doesn't replace a broken furnace. And equity doesn't cover an insurance bill that's suddenly much higher than last year. Those expenses are paid with cash, month after month, year after year. That's where many budgets begin to crack. How?
A mortgage payment is easy to see.
The other costs arrive one by one. A tax notice, an insurance renewal, a plumbing leak, an air conditioning unit that stops working in the middle of July.
Individually, none of these feels like a disaster.
Together, they change the true cost of owning a home. And unlike the purchase price, these costs don't end on closing day.
They become part of everyday life.
Here's the interesting part. Banks are not trying to hide these expenses. Most of them are disclosed somewhere in the paperwork. The problem is that buying a house is an emotional experience. People naturally focus on getting approved, finding the right neighborhood, and making it to closing day.
Very few spend the same amount of time imagining the financial decisions they'll still be making 15 years later.
That's why two families can buy nearly identical homes and end up with completely different financial futures.
In the next chapter, we'll look at the first hidden cost that continues long after the excitement of moving in is over, and why it often grows even when your mortgage doesn't.
The first bill that never goes away. Most people expect their mortgage payment. Very few expect everything else.
A few months after moving in, the excitement starts to fade. The boxes are unpacked. The walls are decorated. Life begins to feel normal. Then the mail starts arriving. A property tax notice, an insurance renewal, a maintenance reminder. None of those envelopes feels urgent on its own.
But together, they tell a very different story about the cost of owning a home. Let's start with property taxes. Unlike your mortgage, property taxes don't disappear after 30 years. As long as you own the home, they remain part of the cost of keeping it. And in many communities, that cost doesn't stay the same. Local governments periodically reassess property values. If the assessed value rises, property taxes may rise as well, depending on local tax rules. That means two neighbors living in nearly identical houses can end up paying different amounts over time. The house hasn't changed, the monthly mortgage hasn't changed, but the total cost of ownership has. For a family already balancing groceries, childcare, transportation and healthcare, even a few $100s a month can force difficult choices. Then comes homeowners insurance.
Most buyers think about insurance exactly once. Closing day. After that, it becomes another automatic payment. Until it isn't. Across parts of the United States, insurance premiums have increased sharply in recent years.
Insurers have pointed to several reasons, including higher construction costs, more expensive building materials, larger weather-related losses, and rising reinsurance costs. These aren't just industry problems. They eventually reach the homeowner's mailbox.
One renewal letter, one new premium, one more adjustment to the family budget. And here's what makes this different from your mortgage. Every extra dollar spent on insurance protects your home.
But it doesn't increase your ownership in it. You're paying to reduce risk, not to build wealth. This is where many first-time buyers experience their first surprise. They carefully calculate the monthly mortgage payment. They compare interest rates from multiple lenders. They negotiate the purchase price. But the costs that keep changing, 64, the ones outside the mortgage, 64, often receive far less attention.
That's not because they're hidden. They're simply harder to predict. According to the Consumer Financial Protection Bureau, the cost of owning a home extends beyond the mortgage payment itself.
Buyers also need to plan for taxes, insurance, maintenance, and other ongoing expenses that can significantly affect affordability. Notice the word they use, affordability, not purchase price.
Not loan amount. Affordability. Those aren't the same thing. A family may qualify for a mortgage and still struggle with the long-term cost of ownership.
That's a distinction many people only discover after they've moved in. But property taxes and insurance still aren't the biggest financial surprise. The next expense rarely arrives in a neat envelope. It usually begins with a small sound, a strange noise from the air conditioner, a water stain on the ceiling, or a tiny crack that nobody thinks much about, until it becomes impossible to ignore. The expense nobody can schedule. Most financial problems don't begin with one catastrophic event. They begin with ordinary life. A homeowner walks into the kitchen and notices a small brown stain spreading across the ceiling. It wasn't there last week.
At first, it seems harmless. Maybe it's just condensation. Maybe it can wait until next month. But water has a habit of turning small problems into expensive ones. The longer it's ignored, the more damage it can cause.
And that's one of the biggest differences between renting and owning. When you rent, you usually make a phone call. When you own, you usually write a check.
Ask homeowners what surprised them most after buying a house, and many won't mention the mortgage. They'll remember the first major repair, a roof that had to be replaced, a furnace that stopped working in winter, an air conditioning system that failed during a heat wave,
or plumbing that leaked where no one could see it. None of these problems arrives on a convenient schedule. They don't ask whether you've just paid for a family vacation, or whether your child is about to start college. They simply happen.
And when they do, the bill often can't wait. Financial planners often encourage homeowners to budget for ongoing maintenance instead of assuming the house will remain problem-free. A commonly cited rule of thumb is to set aside around 1% to 3% of a home's value each year for maintenance and repairs.
It's only a guideline. Some years you'll spend much less. Other years you'll spend far more. That's the nature of owning a physical asset. Every roof ages. Every water heater reaches the end of its life. Every heating and cooling system eventually needs repair or replacement. Time doesn't negotiate. This is where cash flow becomes more important than home value. Imagine two homeowners. Both own houses worth $600,000. Both have similar mortgage balances. On paper, they look equally successful. Then both need a $15,000 repair. One family pays from an emergency fund. The other turns to high-interest credit cards. The repair is identical. The financial outcome isn't. The difference wasn't the house. It was preparation. That's a lesson the housing market rarely teaches. Home ownership builds wealth slowly. Repairs demand cash immediately. Those two timelines don't always work together. And when they collide, families are often forced to make difficult choices. Delay the repair, borrow the money, or cut spending somewhere else. None of those options feels like the dream they imagined when they picked up the keys. According to guidance from housing counselors and consumer finance experts, setting aside money for maintenance is one of the most overlooked parts of buying a home. Not because people don't care, because it's easy to believe that today's quiet house will stay that way forever. Until one ordinary morning, when something stops working, and the next financial decision is no longer optional. If repairs are unpredictable, there's another cost that's even harder to notice. You never receive a bill for it. You never write a check for it. But over 30 years, it can quietly become one of the most expensive parts of owning a home. It's called opportunity cost, and almost nobody talks about it. The cost you never receive a bill for. There is one housing expense you'll never find in your mailbox. No invoice, no payment reminder, no late fee. In fact, many homeowners don't realize they're paying it at all. Economists call it opportunity cost, but the idea is much simpler than it sounds. Every dollar committed to one goal is a dollar that can't be used somewhere else. Imagine two friends. Both earn similar incomes. Both have similar families. Both buy homes at about the same time. One stretches every dollar to purchase the biggest house the bank will approve. The other buys a smaller home and keeps a larger financial cushion. At first, the first family appears to be winning. The house is larger. The neighborhood is newer. Friends are impressed. But a few years later, life changes. One parent loses a job. Medical expenses appear. The roof needs repairs. Suddenly, the family's budget has almost no room to adapt. Not because they made a reckless decision, but because nearly every dollar had already been committed. The second family faces many of the same challenges. Repairs still happen. Insurance still increases. Property taxes still arrive. But they have something different. Flexibility. That flexibility isn't visible from the street. Neighbors can't see it. Social media can't photograph it. But financially, it may be one of the most valuable assets a household can have. This is one reason financial advisors often encourage buyers to think beyond what a lender says they can afford. A lender evaluates whether you can make the loan payment. Only you can decide how much financial flexibility you want to keep after moving in. Those are different questions, and they often lead to very different outcomes. According to the Consumer Financial Protection Bureau, homebuyers should consider not only the mortgage payment, but also emergency savings and the ongoing costs of ownership before deciding how much home to purchase. That's practical advice, because life rarely follows a perfect budget. Cars break down, children grow, parents need care, jobs change. Jobs change.
Unexpected expenses don't wait until the timing feels convenient. Here's something worth thinking about. People often compare homes by asking, how much larger is this one? A different question might be even more important.
How much freedom am I giving up to own it? That question doesn't appear on real estate listings. It doesn't show up in mortgage advertisements. But over 20 or 30 years, it can shape almost every financial decision a family makes.
Owning a home has helped millions of Americans build long-term wealth. Historical data supports that.
But building wealth has never meant eliminating risk.
In fact, owning a valuable asset often means accepting new responsibilities, new expenses, and new uncertainties. That's not a reason to avoid buying a home. It's a reason to understand the full commitment before signing the paperwork.
And there is one more cost that almost every homeowner pays. Not to the bank, not to the insurance company, not to the local government,
but to time itself. Because every house, no matter how beautiful it looks today, is slowly getting older.